So in today's video, I'll be covering all the different white moat stocks. And for reference, this is my portfolio. So I own a lot of different companies here, and a lot of them that I view that are high quality. So in today's video, I'll be covering all these different companies. So the first stock that I'll be talking about in your luxury segment is actually Hermes. So Hermes year to date is up around 3%. It is currently trading at a 54 times earnings. So I view Hermes as the king in luxury. And for Hermes, this is why the company is so good. So the company is basically amazing at promoting a scarcity mindset. Basically what they do is they make consumers, they make buyers wait for a very long time before they can actually buy a Birkin. So before you're actually allowed to go into a store and buy a Birkin, what you need to do is you need to buy a lot of the different accessories first, and you need to become a member, of course, before you can progress and buy the Birkin itself. So the Birkin is extremely scarce, and that's why the resale market is so much more expensive as compared to the actual authorized dealers. So for Hermes, it has incredible pricing power as well. So this company is able to increase the prices at levels above the rate of inflation, simply because Hermes' target audience is basically the richest people in the entire world, and all these people, they are not susceptible to inflation or any sort of economic downturn. So for Hermes, the multiple has always been extremely high. So the company has historically traded at between a 30 to 50 times earnings, and that is because of the quality of the business itself. The next company that I'll be talking about will be in your software space. So this company is Microsoft. It is up around 22% year to date. It is currently trading at a 39 times earnings. So for Microsoft, when you're buying this stock, you're basically buying an ETF of all these different businesses here. So Microsoft is one of the most diversified software companies out there. They have a lot of different business models under them, and that is the quality of the business itself. So for Microsoft, it has always been able to crush its competitors. So they have the bundling mode where they can basically bundle everything together and sell it as a best package to all the different corporate consumers. So for example, this is Microsoft versus Slack. So Slack is a company that was bought by Salesforce. They were touted to basically compete with Microsoft Teams. And at one point, Slack was actually leading Microsoft Teams. But as soon as Microsoft Teams was basically bundled into the deal, it led to a massive increase in the daily active users. And now as you can see, Microsoft Teams is well ahead of Slack. The other one is Microsoft Teams against Zoom. So a lot of your different corporate companies, they already have a Microsoft subscription. So there's no reason for them to add on to that by subscribing to Zoom as well. So that is the quality of the company. The company is basically able to bundle everything together. And that's why for Microsoft, I view it as the highest quality software company out there. The next company that I'll be talking about is in your hardware space. This company is ASML. It is currently trading at a 24 times earnings, up around 2% year to date. So for ASML, these are the machines that they sell. Basically what they sell is your lithography machines. So they sell these machines that basically print your patterns on your wafer, which is important for everything that you use in your daily life. So all your electrical appliances needs to have a chip with all these wafers being patterned, and that's what ASML provides for its customers. So for ASML, it is an enabler of your Moore's law. So Moore's law basically suggests that your chips will have double the number of transistors every 2 years, while the cost per transistor will actually decrease over time as well. So this will drive up demand for ASML's cutting edge lithography tools, because their EUV lithography basically allows their consumers to decrease the cost per transistor by replacing complex multi-step patterning into single EUV layers. So this is why ASML's customers keep buying their machines, because the machines, they provide even more efficiency over time. So for ASML, they spent around 30 years trying to design the EUV, and it will probably take billions and billions of dollars for another company to create this technology as well. And by then, ASML will probably be well ahead already. So besides that, when you're buying an EUV machine, there are two things for you to consider. Number one is the yield, basically how many chips that come out from the machine can be used. The second one is the cost. So while there are alternatives to ASML, they can't match ASML in terms of the yield as well as the cost, and that's why ASML is still leading in this technological battle. And for ASML, it also has the most dominant share in the entire wafer fab equipment section. So it is the only company that holds basically a monopoly in its segment. All these other companies here, they own small fractions of each different segments, and that's why ASML is probably the highest quality company in this entire list here. The next company that I'll be talking about is in your payment segment. So this company is actually Visa and MasterCard as well. So Visa is up around 13% year to date. It is currently trading at a 35 times earnings, and I view it as the highest quality payment company out there with the highest moat. So for Visa, this is the network effect. So Visa is basically the middleman of 5 different people. So when you have your consumers buying from your merchants as well as your banks, Visa is basically standing in the middle, collecting the fee and transferring the money over from your issuing bank to your merchant acquiring bank. So for Visa, they have amazing network effects because the merchants, they have to use Visa, because if they remove this Visa payment network, then they will risk losing customers. So this is sort of like a network effect feedback loop for Visa as well, where more merchants leads to more buyers using their platform, which leads to even more merchants as well. So for Visa, they're basically a toll gate for global payment volumes. So they have multiple different secular tailwinds basically pushing the company. So as your global population increases, as more money gets printed, as more people spend money, you see more money being transacted through Visa's platform. And when that happens, it leads to even more growth for Visa as well. So for Visa, the competitor is basically just cash as well as Bitcoin. I don't see Bitcoin as a superior competitor right now, but that could be a problem in the future. As for cash, it is basically a non-fighting competitor. So in the entire world, a significant portion of your transactions is still made in cash. And as people transition from cash to all these transaction platforms, you will see a lot more growth for Visa as well as MasterCard. The next company that I'll be talking about will be in your credit rating services. So this company is actually S&P Global as well as Moody's. So these two companies, I view them as extremely monopolistic, high quality business. They operate in a duopoly with around 40% market share each. So for S&P Global, they have secular tailwinds as well, similar to Visa. So the debt market is increasing over time. It will always keep increasing as credit drives the entire market. And when that happens, you will see S&P Global as well as Moody's having much more growth in terms of the credit rating portion. And that is the beauty of the business itself. So besides that, S&P Global as well as Moody's, they're basically toll gate businesses. What they do is they rate the company's debt and then they take a percentage as a fee of the actual debt itself. So for S&P Global, it has amazing brand, and that's why the company is able to operate at such a high level of profitability even after so many years. So Moody's first started their bond ratings in 1909, and then Standard & Poor's actually came in at 1916 as well as 1922. And that's why these companies are so trusted, because the company is basically a language in your credit rating. There's no incentive for those who want to sell debt to basically switch, because it will cost even more money for them to switch. So let's say a company is trying to sell their debt and they get it rated by S&P Global, they will likely be able to get a much lower interest rate on that as compared to other companies providing the same service. And that is why all these different companies, they will keep going back to S&P Global as well as Moody's, because they're the most trusted, they're the most well-known, they have the strongest brand in your entire credit rating business. The next portion that I'll be talking about is in your consumer and retail segment. So in your consumer and retail segment, I think the strongest company is Amazon. So Amazon year to date is up around 5%. It is currently trading at a 37 times earnings. So for Amazon, this is the amazing part of the business. So besides network effect and the AWS business, the company has also amazing infrastructure. So competitors will have to spend billions and billions and billions of dollars to basically build out all these different fulfillment centers. And it is almost impossible for any company to come into this space because of Amazon's sheer scale. So for Amazon, they also have amazing network effects. So they own a lot of different businesses here, and it is sort of like a loop. So Amazon users will naturally go to their Prime Video and so on and so forth. So it is sort of like a loop for the company as well, where more customers leads to even more customers, which leads to even more customers. So for Amazon, I view it as a high quality business, and that's why I own a large portion of my entire portfolio in Amazon. I think the company is positioned very well to benefit in terms of AI as well as your robots. So for Amazon, I view it as a high quality business and the highest quality one in your entire retail segment. The last segment that I'll be covering is in your railway companies. So in your railway segment, all these different railway companies have incredible moat. Why? Because all these different railway companies, they have billions of dollars being spent on all these different rails, and it is almost impossible for any competitor to come into this space and basically build out their rails, because number one, it won't be economically viable, and number two, it will spend years for them to basically build out all these rails that are existing already. So that is the barriers to entry for all these different railway companies, and that's why they're incredibly high quality businesses. Although they won't grow massively, they will bring in a predictable stream of income almost every single year. Last portion that I'll be covering includes some questions left in the comments. So the first one, it says if Adobe beats earnings and drops another 20 to 30%, then you'll buy. One, do you really think a stock like Adobe that's already down 30% in the last 12 months, trading at below its 50, 100-day, as well as 200-day SMA, will drop even more? I really think you need to take more risk. Even your stocks with wide moats and deep value like MSCI and ASML are all falling. Your overvalued plays like AMD, Nvidia, Palantir, SoFi all keep printing, just to name a few. So I don't really agree with this statement. I think as an investor, what you should be actively doing is to reduce your risk and maximize your returns. So there is a common misconception that a lot of investors, they think, which is that more risk leads to more rewards. But that is actually untrue. What you need to do as an investor is basically take on less risk so that your reward over time will be even larger. And for all these different companies that he named, every single one of them, there's probably another company in the space that has dropped 80-90%, but no one is talking about it. So I'll continue buying all my high quality companies, and maybe over the next 5 to 10 years, maybe I'm wrong, but I stand by my investing philosophy of taking the lowest risk and buying the highest quality businesses in the entire space. The next portion, it says I should have sold, holding for over a year, and yesterday was my only chance to live with a very small loss. Could have used that 20 grand elsewhere. F my life. So this is with regards to ASML. This was when the stock dropped by around 10%. So in my opinion, what you should be doing as an investor is to basically detach your emotions from the stock price. And in ASML's case, the business is no different from before when it reported its earnings. So stay calm and of course be greedy when others are fearful, as Warren Buffett says. I hope you guys have found this one useful and invest safe.